We will now take a look at various forms of asset classes from stocks, bonds, and other forms of derivatives. So we'll kick off with our bonds. This section will focus very heavily on just understanding how bonds work and the relevance it has to investment portfolios, the pros, the cons, and who it's really designed for. Okay, government bonds in essence are a debt security which is issued by the government in order to raise funds for various purposes, and this could be to raise money for financing public projects. It could be infrastructure development or covering any form of budget deficits. So bonds are generally considered to be low risk investments because they are backed by the government's ability to tax its people and print currency whenever they feel they may need to repay the debt. Okay, government bonds are, corporate bonds are very similar. It's just another way of companies raising finance, and in turn, the principle remains the same. But with government bonds, let's use a very simple example. Let's say, for example, we are purchasing a 10-year bond for £1,000 and we've got a fixed interest or a coupon of 5%. This means that for every year you will receive £50 for the duration of that 10 years. So you will receive £50 every year for 10 years. And at the 10-year period, once it reaches 10 years, you will get the principal amount back, which will be the £1,000. So in general, government bonds are very popular amongst investors, as it is a vehicle for investors to not only park their money in times of uncertainty, but also a great way to get a predictable income. And naturally, you will know how good their credit is by looking at their credit rating. Now, what we've done here is put out a number of headings for how a bond is traditionally issued. The issuer is usually a government agency or a government, or it could be a corporate entity. When it comes to the maturity, there's always going to be short, medium, and long-term bonds. So bonds can be up to 7 years, 7 to 15, over 15 years. You can have bonds which are less than a year. A lot of money market instruments such as T-bills are less than a year. But it will depend on which country you look at, as they won't have a standard short, medium, long term. It will vary in years. When we talk about the face value, this is in essence the amount of money that the bondholder will receive upon maturity. This is what you've bought it for. So in our example, it was £1,000, and so that's what you will receive after a 10-year term. The coupon rate is the interest payment that you are expected to receive. It could be annually, it could be semi-annually. So that interest rate will be fixed. There are also bonds which are classed as zero coupon bonds. In essence, they do not pay interest yearly, but in essence, they are sold at a discount to face value. So if there is a bond priced at £1,000 face value, they will sell it at £900. And at the end of a 1-year term, for example, they will redeem that bond and pay you £1,000. So you have made £100 on that bond. When we talk about the yield is in effect the total amount you will receive at the end of the term. So we call it yield to maturity. That takes into account not only the coupon payments, but also the purchase price that you purchased it at. That will vary, especially if you're buying a bond at a discount to market value or at a premium. So the yield can always change depending on interest rates and so forth. Now, credit ratings are essential when it comes to not only government bonds, corporate bonds, and also the general health of an overall economy. There are 3 rating agencies. You have Moody's, Standard & Poor, and Fitch, and they give a rating which we will have a look at very shortly. AAA rating is always the best form of rating you can get, which means it's highly unlikely for the issuer to default on the payments, not only of interest, but also at maturity. So in a nutshell, bonds are a way of raising finance, and that finance can be used for a multitude of situations. You are getting a fixed interest on a yearly or a semi-annual basis, and you will expect to receive that back, or the principal par value back, at the end of the term. So that is bonds in very small nutshell. Okay, when it comes to the credit rating agencies, as mentioned in our previous slide, there are three agencies. You've got Standard & Poor, you've got Moody's, as well as having Fitch. They are independent organizations. Their aim is to assess the credit worthiness of issuers of the debt security. So when we talk issuers, we mean the governments or corporations or any other special entities out there. So their aim is to evaluate the ability of the issuer to meet its financial obligations, in particular the ability to pay back the debt in a timely manner. And when we talk about the assessment, it's usually provided through an alphabetic symbol. AAA, as mentioned earlier, is it's the highest rating you can possibly get. But when it comes to how investors perceive the information, it forms a major part in our risk assessment, because credit rating agencies do provide valuable information, not only to investors but also to the lenders, by understanding and assessing the credit risk associated with various debt. And what they do is they analyze factors such as financial performance, market conditions, industry trends, economic outlooks, and this naturally will help investors as well as lenders, in deciding whether this debt is worth taking on. One good thing about all the agencies, it does come in a standardized form, the way they measure the risk. It allows the lenders to compare the credit worthiness of different issuers and debt instruments a lot more easier. And that tends to make the markets a lot more efficient. Investors can rely on the credit rating agencies, as they are seen as an independent source of credit risk, and it does help promote a lot more liquidity as well as price discovery within the debt markets. But if we look at it from the issuer standpoint, there are a lot of benefits of that as well. Governments and corporations will often seek credit ratings or credit rating agencies to come in and evaluate their risk. It does help their credibility, and makes the bonds a lot more favorable to investors, as they know that the issue has gone out, got a rating, and the valuable feedback to the issuer will actually help them promote their bond that bit more, and hopefully promote a lot of financial health and credit worthiness for their debt securities. And like I said, it can be from governments, it can be corporates, anyone can have their debt evaluated. Here is a list of the rating agencies and how they alphabetically do their rating. So investment grade is always going to be AAA. Even if you get notched down from AAA to AA, that can have a big impact on marketing your debt, and it could make it a lot more difficult. So just because you do fall within the investment grade, ideally you've got to be within the AAA band. If you get into the speculative nature, these could be corporates or governments which are facing a lot of difficulty, and you will have, if you do take on that form of debt or that bond, the issuer, government or corporate, will more than likely entice you with higher coupons in order to make your investment that bit more fruitful. So as an investor, if it does come off and they do pay back in a timely manner, you will get a higher yield to maturity than you would do if you invested in an investment grade bond. So you've got to take everything with a pinch of salt, but ideally, if you are looking for a safe haven where you can park your money and get reliable interest yearly or semi-annually, you want to be looking at investment grade bonds. Speculative bonds, if you have a larger risk appetite and you're not so much concerned about being repaid in a timely manner, that could also pay off. But ideally, from an investor standpoint, investment grade bonds are the way forward. Okay, we'll look into the reasons why bonds are issued. Why do governments, central banks, corporations look to issue bonds? What's the reason for raising finance? One of the key reasons would be financing budget deficits. This will occur when government expenditure actually exceeds revenue. So by selling bonds, governments can borrow money from investors to finance any form of public spending programs that it may have in the pipework without having to raise taxes or cut expenditure. Funding infrastructure projects is one of the main ways of using bonds. In essence, you are raising capital for, for financing large scale projects. It could be the likes of HS2, other roadworks, bridges, airports, but they're naturally for very large operations. Governments and corporations may be struggling with short-term cash needs. So it would be a case, and this could be up to the course of a year, probably not longer than that. So bonds are issued in order to provide the liquidity and plug any cash flow gaps that there may be. So as mentioned before, it is very much corporation and government based in order to cover a lot of these short-term needs. When it comes to debt financing, bonds are really issued can be used to refinance existing debt obligations, especially when interest rates are a lot lower than what the existing debt that is outstanding is. So it does allow entities to reduce debt servicing costs, maybe extend debt maturity, or really just change the debt terms to better align with their financial objectives. During periods of economic downturns or recession, governments will look to issue bonds as part of a stimulus package to stimulate economic activity and really support recovery efforts. So, bonds may be used to fund infrastructure project, unemployment benefits, or any industries which they find may be struggling during the downturn. When it comes to monetary policy implementations, central banks will use government bonds as an instrument of monetary policy to influence interest rates and maybe manage liquidity in the financial system. So in essence, buying and selling government bonds in the market, central banks can adjust money supply levels. They can inject money or take money out of the system, and that will influence borrowing cost, and it can also support economic stability. Uh, Bonds can be used for benchmarking. There's two ways to look at this one, especially if you are investing in a managed fund or an investment trust or any other form of package product. A lot of the fund managers will compare the fund to a risk-free rate, and that is in essence bonds. They tend to be risk-free to a certain degree, and a lot of fund managers will use that to see how well the portfolio has performed as compared to the risk-free rate. They're also issued in order to help set interest rates on various financial products, which is the likes of mortgages, corporate bonds, as well as a loan. We do know that bonds are seen as a safe haven. They are also counter-cyclical to the current market conditions. So if, for example, the markets are rallying and it's very much risk on, investors are more than likely to invest in equities or indices or funds where they're more than likely going to get 4, 5, 6, 7, 10%, for example. Whilst when it comes to government bonds, the returns are relatively low. Even though your money would be safe, it is relatively low. So in a good market, equities are more favorable. In a weak market, bonds tend to be a lot more desirable due to the fact that you are able to park your money as well as receive a solid interest. So that's what bonds are initially designed for. Okay, now we're going to look into what affects the prices of bonds as well as yields. But when we talk about the price of a bond, that in essence is the price you pay for a bond. It can be different from the fair value. You can buy bonds at a discount, you can buy bonds at a premium. So bear that in mind. When we talk about yields, that mainly is the yield to maturity. So what are you expected to receive at the end of, let's say it's a 10-year bond, at the end of 10 years. That takes into account your coupon payments as well as the price you actually paid for the bond. Now, let's look into our first element, which is going to be interest rate risks. Now, interest rate risks play a big factor, obviously, on bond prices and yields due to the fact that they have an inverse relationship with both. So when interest rates rise, existing bond prices tend to fall. This will adjust the yields upwards in order to compensate investors, and also vice versa. If interest rates fall, bond prices go up. Now let's use a very simple example. In year one, you can buy a 10-year government bond for £1,000 and it will provide you with a 4% coupon. Great. But if interest rates go up, in year two, new bonds are issued, for example, and they're 10-year bonds. You pay £1,000 for them, and they will issue a 5% coupon. You may ask yourself, which one will you go for? Well, rightly so. You are going to go for the one which is for 5%. 5% coupon. You get more interest every year, which is absolutely fine. Now, what tends to happen is when that occurs and interest rates go up, the existing bonds, so from year one, those bonds which are issuing a 4% coupon will now revise their price lower. You can now maybe purchase that bond for £900. By doing so, your yield to maturity will be pretty identical to what investors in year two are going to receive. It adds some degree of stability to the overall market. But yeah, those are the main reasons why prices and yields go up and down when it comes to interest rates. Now, inflation is a big factor, especially a massive talking point in today's market, or it has been for the last couple of years at least now. We know inflation erodes purchasing power, and that purchasing power does filter into fixed income payments for bonds. So what tends to happen is, in order to make them a lot more attractive, prices will tend to go down, and that will send yields up. It's just a way of countering inflationary effects. But there are bonds which are more closely related to inflation, which will adjust in line with inflation. In the US, you will have Treasury inflation protected securities, TIPS for short. Here in the UK, we've got index linked gilts. And so they're there just to protect you against any effects of inflation. And yeah, it makes it ideal, especially if we're in a climate where inflation is rallying or very volatile. Now, when it comes to credit risk, we've already discussed the rating agencies, Moody's, Standard & Poor, as well as Fitch. They place a rating on bonds. Higher the rating, great, AAA, great. Lower the rating, bad. It means potential default. So what you will need to look into is any company with a low credit rating, they will typically offer higher yields. This is to compensate investors for the increased risk of default. Okay, so you could have Germany, for example, they'll issue a bond with a yield to maturity maybe 10–15%, whilst a UK gilt, a government bond, will provide you with only a 3%. You've got to decide what is your risk appetite, what are you looking to achieve. If you're prepared to lose your capital and get unreliable payments, you can take the higher risk. But if you prefer something more safe, you can park your money in AAA rated bonds. Now, understand the difference between a government as well as corporate bonds. Corporate bonds will always have a higher credit risk than government bonds. Government bonds are backed, they are guaranteed. As we know, governments can raise taxes, they can easily get the money to pay back investors. Corporations have the risk of default, managerial issues, revenue, balance sheet issues, and that can have a big impact on repayment of debt. They could have solvency issues. So those are the two factors. Always look at the credit rating of corporate bonds. Now, when it comes to economic conditions, again, it's just touching on from our earlier points. Look, a strong economic growth within any form of economy usually tends to lead to interest rates going up. It's a way of the central banks wanting to control inflation. And so that naturally will lead to lower bond prices. That will lead on to higher yields. So always bear that in mind. So what a recession would do is the market would be in a downturn. Uh, Interest rates naturally will go down in order to stimulate growth. Bond prices will naturally go up, and then the yields will come down. The reason that being said is they want to have control in the market, because if interest rates come down, the new bonds are issued are only going to be providing you, let's say, 3%, whilst the year before they were providing you with a 4% yield. Naturally, people will always focus on the 4% yield. But what they tend to do in order to add stability within the bond market, the prices now will go up for last year's bonds in order to make it that bit more competitive, so that there's no big differences between new bonds and old bonds issued. Of course, there will always be better priced bonds than others, but there won't be such a massive gulf. Okay, so traditional supply and demand factors. The government has the ability to issue as many bonds as they want, or they can redeem bonds. So it's just a way of putting money into the market, taking money out of the market. The issuance of bonds and redemptions of existing ones will affect a lot of the supply. Let's say, for example, they've increased supply where the government is focusing on higher borrowing. That can actually send prices lower. If you've got an increased amount of supply and not a huge amount of demand, prices can go down. But if there is an increased demand, and that usually tends to happen in times of uncertainty, recessions, that can naturally boost prices. Of course, there will be effects of lowering interest rates, which boost prices as well. But the supply and demand factor is something to bear witness and be fully aware of. Pension funds, insurers, and retail investors, they are the main drivers when it comes to the supply and demand. Okay, I just wanted to just go through how the UK bond market actually works, and a few of the ins and outs when it comes to it. So, as we know, a bond is an agreement to pay back an agreed amount at some point in the future, and in the meantime paying interest while the debt remains outstanding. Those are the key fundamentals of a bond. Here in the UK we call it gilts, and again, gilts can come with multiple different maturities, as you can see at the end of this chart here. There will be short-term or medium dated or long dated gilts. Usually short dated is up to 7 years, a medium is 7 to 15, and over 15 is classed as long dated gilts. Now, here in the UK, the government has historically spent more than it has received in tax revenue, and I think that can be said with majority of the developed nations. But here we call the shortfall, it falls under the public sector net cash requirement, so the PSNCR. This is a measure used in the UK to assess the government's financial needs. In essence, it represents the difference between the government's cash flows and outflows over a specific period of time, predominantly over a fiscal year. So when it comes to the public sector net cash requirement, they just want to understand the government's financing needs. So what they tend to do is they look at the government's revenue. So that takes into account tax receipts, dividends, any enterprises that they may own, or any other sources of income. Then they look at the government's spending. That includes operational expenses, debt servicing costs, investment into infrastructure, or even social welfare. They also look at capital expenditure. That refers to the government spending on a long-term basis, and that could be buildings, infrastructure, anything like that. Then, as well as taking into account debt issuance and repayments, they'll look at the cash reserves as well as the management, and that's going to make up the key part of what the public sector net cash requirement will look at. Following that, it's down to the HM Treasury. They will then delegate authority to the DMO, which is the Debt Management Office, and they will be responsible to, in essence, borrow money to fund the public sector net cash requirement. And so the main way they go about funding is, as we've just already discussed, it's going to be UK government bonds. That's going to be via gilts. It can be medium, short, or long term. There will be treasury bills, which run up to a year. And then you will have national savings and investments, or NS&I. So those are the typical means of raising finance to plug any sort of deficit that is out there, and it is the responsibility of the DMO. And then, when it comes to government bonds, the Debt Management Office will organise bond auctions, so they can be competitive and non-competitive auctions. It allows investors, hedge funds, big banks, pension providers to then, in essence, start buying as much debt as they want, and any of the finance raised will typically go to filling any sort of gap, as we've just mentioned. We have touched on the different types of gilts. In our previous slide, we did touch on index-linked gilts, which are inflationary protected bonds. There are short-dated gilts and treasury bills, to be more precise. That naturally tends to match any short-term cash requirements governments may possibly need.